So anytime, if you can look at the previous structure, right, you can see price was going bullish, right, for some time. And all of a sudden, right, price breaks this low, right, then it turns bearish, which means now we have supply overtaking the buyers, right, which is very typical. However, have you guys known, and I'm pretty sure a lot of you guys have experienced and or have seen that the market, when the market goes below a low or a high, it does typically sweep liquidity, which is it could be in the form of a swing low. It could also be in the form of double bottoms. It could be in the form of relative lows, like so, right? And then price runs back the other way, just like this, right? Just like this example, right? So in this case, you wouldn't be wrong to say, if you waited for a break of this low right over here, you wouldn't be wrong to say to look for an entry right here at the supply, right here, right there. Because we know that's a weak demand, strong supply. That means demand is weak to take out this high, supply is overtaking, so that means the last supply zone that we need to mitigate is this supply zone, right? However, this is all good and gravy. It's a great textbook example, but a lot of traders hate to take these ones because a lot of traders are fearful of taking this because of this scenario. So say, for example, again, right here, we don't have this chalk broken, right? Right here we have buyers buying and sellers are selling, right? Both buyers and sellers are contradicting the direction, the direction of the move, right? The direction of the entry, let's just say, because if this was our supply zone right over here, okay, something like this, and we're all good and ready, waiting for supply here for the supply to be respected, then we understand that this here needs to be supply based, not bullish based. Okay, that means that at some point in time the buyers are going to stop here, right, and not continue to exceed above the supply zone right here, right? So that means we are typically wanting for the bears, for the supply to take advantage of the direction. So how do we do that? Well, first things first, my type of entries that I like doing is looking at where the highs and lows are, especially for liquidity, okay? Because we know liquidity is the driver of the market. Therefore, I am buying in on the liquidity-based entry, not on the break of the low entry. Now, every low and every high is liquidity, okay? However, if my bias is bearish and this is a supply zone, I want to take the utmost, biggest move for price to run. As soon as we're in the supply, I want price to run, right? I want price to explode. So what do? I start looking to mark my supply here, and I mark out, I have to literally and visually see that there is another high, internal high right here. Okay, just like that. Once I see that internal high, that would be the inducement, okay? And that's where I would enter the market, right over here. Now, the reason why I would do that is because many times, as we know, the market does not give us perfect conditions. It doesn't give us the perfect entry conditions all the time, but when it does, it does. When it doesn't, then we feel sometimes like we're let down. It's depressing, right? Why am I not able to catch an entry right over here when price literally just starts to run from here? Just doing, pretty much this example, right? Like, you would wait for prices to come right over here, right? You wait for price to come and give you that chop, that change of character. However, it's been respecting this demand zone, right? You can see weak demand, strong supply. However, the market went above these buyers, right? This high, swept it, and continued bearish, right? So this is my indication, right? This is what's considered a falling knife. Now, this could be a falling knife. Essentially, is when price is still bullish, okay, and people are afraid to take the sells or the buys. In this case, it could also be a buy, right? So if let's see, something like this, actually, there we go, right? And we get something like this, right? Price has not broken the chalk yet, or the high, just like this, right? And then we take an entry right here, right, at this demand zone, boom, right? And to do something like this, and then good luck trying to catch the market because it's on its way to run bullish, right, impulsively. Now, this happens for various reasons, but one in particular reason is because of the liquidity setup that price has already presented itself with, which is right here, right? So that will be your liquidity, okay? Every high and every low is liquidity. Swing highs, swing lows are liquidities, as well as relative lows, relative highs, double tops, double bottoms, triple tops, triple bottoms, okay? So everything in the market is liquidity. However, these are the most extreme and most impulsive entries in the markets that you can ever find, and they work amazing.